Hi everyone, continuing from our last session on asset allocation, today we will dive deeper into how it applies specifically to mutual fund portfolios. Today is day 97 of our 365-day financial fitness challenge. Imagine you are building a house. You wouldn't use just bricks, would you? You will need wood for the roof, concrete for the foundation, and maybe even metal for plumbing. Asset allocation in mutual fund is similar. It's about using different types of investments like different building materials to create a well-rounded portfolio. Now, what is asset allocation in mutual funds? Think of a mutual fund portfolio as your investment toolbox. Asset allocation is how you decide which type of mutual funds and therefore asset classes to put in your toolbox. Here are main types of asset classes. The first one is stock, which is equities. Equities represent ownership in companies and generally offer higher potential returns but also come with higher risk of price fluctuations. Next type is bonds, which is fixed income. Essentially, IOUs from governments or companies. They offer steadier income but typically lower returns. Next comes cash and cash equivalent. Very low risk investments like money market funds used for short term goals or emergencies. By combining these asset classes in your mutual fund portfolio, you achieve diversification. How asset allocation manages risk. Imagine a delicious pizza. You wouldn't want it to be all crust, would you? Asset allocation helps you to build a pizza with a balanced crust, a favorable sauce base, and a variety of delicious toppings, representing the different asset classes in your portfolio. Now, how asset allocation helps manage risk? There are risks like market fluctuations. Stocks are generally more volatile than bonds. When stock prices fall, especially in bear market, bonds tends to be less volatile and even increase in value. This helps offset the losses in your stock holding and smooth out the overall value of your portfolio. Let's imagine you have a 60% allocation of stocks and a 40% allocation to bonds. If the stock market declines by 10%, your stock holdings would lose 10% of 60%. That is just 6% of the value. However, the bond portion of your portfolio might stay flat or even experience a slight gain during this time. This helps cushion the blow of the market downturn to your overall investment balance. The second reason can be unexpected events. Life throws curveballs, and sometimes you might need to access your invested capital sooner than expected. Having a diversified portfolio with different asset classes helps you weather these unexpected financial needs. For example, if you need to make a sudden car repair, you might be able to access funds from the cash or bonds portion of your portfolio without having to sell your stocks at potentially low price point during a market downturn. This flexibility can be crucial in managing your overall financial well-being. Next comes long-term goals. Asset allocation also helps you stay on track for your long-term goals. By including mix of asset classes with different growth potentials, you can balance the need for capital appreciation or growth with income generation and capital preservation. Let's say you're saving for retirement 20 years down the line. You can allocate in higher percentage of your portfolio in stocks which have the potential for significant growth over the long term to help you accumulate the next stake you will need. However, as you get closer to retirement, you might gradually shift your asset allocation to include more bonds and cash equivalent to protect your principal and generate income to live on. Now let's talk about how to choose your asset allocation. The ideal asset allocation for you depends on several key factors. First one can be investment goal. What are you saving for? Are you saving for retirement nest egg, decades down the line, or a down payment on a house in a few years, or a child's college education 10 to 15 years from now? These goals have different time horizons, which means they can tolerate different levels of risk. Generally, the further out your goal is, the more risk you can take on in your portfolio because you have more time to ride out market ups and downs. For example, if you are saving for retirement 30 years away, you can focus more on growth oriented assets like stock, which have the potential for higher returns over the long term. But if you're saving for a down payment on a house in 2 years, you will need to be conservative with your asset allocation, prioritizing capital preservation over high growth. It also depends on your risk tolerance. How comfortable are you with potential losses in your investment portfolio? Some investments are more risk averse, meaning they prefer to prioritize the safety of their principal, even if it means sacrificing more potential returns. Others are more risk tolerant and willing to accept greater volatility in exchange for the chance of higher returns. Your risk tolerance is a personal characteristic that you should honestly assess before making any investment decisions. Next, it depends on the age. Generally, younger investors have a longer time horizon for their investment goals and can therefore afford to take on more risk. As you get older and closer to retirement, you will naturally want to become more conservative with your asset allocation to protect the retirement corpus you have accumulated. Many mutual funds themselves already represent a diversified mix of assets. These can be categorized by their investment objectives, such as growth funds, which are mainly aiming for capital appreciation through mostly stocks. There can be income funds, which focuses on regular income generation through bonds, or balance fund, which combines stocks and bonds for mix of growth and income. There are also specific types of mutual funds called asset allocation funds. These funds invest in a predetermined mix of asset classes such as stocks, bonds, and cash equivalent based on a specific investment strategy. This can be a simpler way to achieve diversification, especially for beginners. For example, an asset allocation fund might target a 70% allocation to stocks for growth potential and a 30% allocation to bonds for stability. The specific mix will vary depending on the fund's target investor and risk profile. Remember, asset allocation is an ongoing process. As your goals and risk tolerance change over time, so should your asset allocation. In the next session, we can discuss how to assess your risk tolerance and choose right asset allocation for your mutual fund portfolio. I hope you have liked today's session. Thank you for joining and see you tomorrow. Bye bye.